Most people who start dividend investing do everything right on paper. They pick decent stocks, they open the right account, they make consistent contributions, and then quietly, without ever realizing it, they make one of three mistakes that cost them not hundreds of dollars, but years. Sometimes a decade or more of compounding growth gone, not from a market crash, not from bad luck, from decisions that felt completely reasonable at the time. These are not beginner mistakes. They are the mistakes that show up in the data when researchers look at why dividend investors underperform the strategy they set out to follow. And the reason nobody talks about them is because none of them feel like mistakes when you're making them. Stay until mistake number 3, because that one is the most common, the most damaging, and the one that the vast majority of dividend investors are making right now without knowing it. Mistake number 1 is chasing yield instead of growth. Here is how this plays out. Someone new to dividend investing searches for the best dividend stocks, sorts by yield, and immediately gravitates toward the stocks paying 8, 9, 10% annually. On the surface, this makes complete sense. Higher yield means more income, and more income means faster progress toward the goal. The math feels obvious, but the data tells a completely different story. A stock paying a 10% yield with zero dividend growth will be worth the same in 20 years as it is today, adjusted for inflation. Meanwhile, a stock paying a 3% yield with a 15% annual dividend growth rate will have a yield on cost, meaning the yield relative to your original purchase price, of over 40% within 20 years. The same dollar invested in the high-yield stock and the growth stock produce outcomes that are not even comparable 2 decades later. There is also a warning sign buried inside unusually high yields that most beginners miss entirely. When a stock's yield looks dramatically higher than its peers, it is often because the share price has dropped significantly, which typically means the business is under stress. A company paying out more in dividends than it is actually earning in free cash flow is not a gift. It is a countdown. That dividend gets cut, the share price drops further, and the investor who chased the yield is left with both a smaller income and a smaller portfolio. The research is consistent on this point. Dividend growth rate combined with payout ratio sustainability is a far more reliable predictor of long-term returns than current yield. The number that matters most is not what a stock pays today. It is what it will pay in year 10, year 15, and year 20, and whether the underlying business can actually support those payments. Mistake number 2 is turning off DRIP at the wrong moment. Dividend reinvestment, automatically using dividend payments to purchase additional shares rather than taking the cash, is the single most powerful mechanism in a long-term dividend strategy. The compounding effect it creates is well documented, and the math behind it is not subtle. As covered in the portfolio projection breakdown from earlier, the difference between a portfolio with DRIP enabled and the same portfolio with dividends taken as cash is not a small percentage improvement over 30 years. It is the difference between a functional retirement income stream and a portfolio that falls well short of the goal. And yet a consistent pattern emerges in investor behavior data. When the market drops, during corrections, recessions, or periods of sustained volatility, a meaningful portion of dividend investors switch off DRIP and start taking their dividends as cash. The reasoning is understandable. The portfolio is already declining in value. Taking the dividend as cash feels like at least getting something back while everything else is falling. This is precisely the wrong decision at precisely the wrong time. When share prices drop, DRIP buys more shares per dollar of dividend than it would at a higher price. Each reinvested dividend during a down market purchases a larger number of discounted shares, shares that will appreciate significantly when the market recovers. Turning off DRIP during a correction and turning it back on when prices recover is the behavioral equivalent of buying high and selling low, applied to dividend reinvestment. The data on this is unambiguous. Investors who kept DRIP active through every major correction in the last 30 years dramatically outperformed those who toggled it based on market conditions. The second way this mistake shows up is earlier than most people expect, not during a crash, but during the early years when the dividend income feels too small to matter. A portfolio generating $40 or $50 a quarter in dividends makes reinvesting feel pointless. The instinct is to wait until the dividends are larger before taking the compounding seriously. But compound growth does not reward patience. It rewards starting. The earliest reinvested dividends are the ones with the most time to compound and are therefore disproportionately valuable compared to dividends reinvested later. Delaying DRIP, even by 2 or 3 years during the early stage of portfolio building, costs more in final portfolio value than most investors ever realize. Mistake number 3 is portfolio drift without rebalancing. And this is the one most people are making right now. Dividend investing tends to attract patient, long-term investors who set up their portfolio and intentionally do not touch it. This is largely correct behavior. Constant tinkering destroys returns. But there is a specific form of inattention that causes significant long-term damage, and it is not obvious until the damage is already done. As a portfolio grows over years and decades, individual positions grow at different rates. A stock that started as 10% of a portfolio might become 25 or 30% simply because its share price has appreciated faster than the others. This concentration risk is not dramatic or alarming. It happens gradually, and the overall portfolio keeps growing, so nothing feels wrong. The problem emerges when that over-concentrated position cuts its dividend, faces a sector headwind, or underperforms for an extended period. A portfolio where one position has grown to represent 30% of total value is not diversified anymore. It is heavily dependent on a single company's performance. The dividend income, the portfolio value, and the compounding trajectory all become vulnerable to one company's decisions. Regular rebalancing, reviewing allocation percentages once or twice a year, and trimming positions that have grown disproportionately large while adding to underweighted positions keeps the risk structure of the portfolio aligned with the original strategy. It also naturally enforces a buy low dynamic, directing capital toward positions that have underperformed rather than chasing the ones that have already run. The research on portfolio drift and dividend income reliability shows a direct correlation. Portfolios that drift without rebalancing show higher income volatility over time compared to actively maintained portfolios, even when the total value appears similar on paper. 3 mistakes, each one invisible at the moment it happens, each one with a measurable cost in compounding years that cannot be recovered once the time is gone. Yield over growth, interrupted DRIP, unchecked portfolio drift. The strategy itself is not complicated. The math works. The compounding is real. The only thing standing between a dividend investor and the outcome they set out to build is consistency in the decisions that are easy to get right, but equally easy to quietly get wrong. If you have been building a dividend portfolio and any of these 3 patterns feel familiar, the good news is that all 3 are correctable. The best time to fix them was the day they started. The second best time is today. If this video helped you identify something worth correcting in your own portfolio, subscribe. Drop a comment below. Which of these 3 mistakes surprised you most? The answers are always more interesting than you'd expect. See you in the next one.